Picture this. You do the responsible thing. You budget, you cut back, and you save money every month until you finally hit $10,000 in your bank account. You feel disciplined, but then you look at your annual yield, and that $10,000 earned a mere $50 in interest over 12 entire months. Saving money protects your cash, but it rarely builds wealth. And this is exactly where the math stops working for a lot of responsible savers. They build a safety net, but they never start growing it because the next step feels completely opaque. Today, we are going to break down the exact 5-step path to move your cash out of a stagnant savings account and into an active investment strategy without exposing you to massive risk. To execute this plan, you only need 3 basic things: a rough idea of your monthly living expenses, a standard bank account with some current savings, and a smartphone. Once you have those, you can begin the process of converting your idle, vulnerable cash into an active wealth-building engine.
Step 1 is building a strict emergency fund. Calculate your bare minimum living expenses, rent, food, and utilities, and multiply that number by 3 to 6 months. This final number is your hard cash target. This cash reserve stays completely in your bank. It is not for investing. It serves as a strict firewall, ensuring that if you lose a job or need a car repair, you don't have to touch your future investments to pay the bill. Step 2 is implementing the 2-bucket system. We are going to digitally and mentally split your finances into 2 specific roles. Bucket 1 is your safety money, and bucket 2 is your growth money. The absolute rule for your safety money is that it never leaves the bank, and its dollar value is never allowed to drop. It is there purely to be stable. Your growth money moves over to a brokerage account. Because its job is to increase in value over years and decades, you must expect its balance to fluctuate day to day. Establishing this boundary early solves the biggest psychological hurdle. When your safety net is isolated in its own bucket, you don't panic when your growth investments dip on a random Tuesday. Step 3 is making your first move. Link your standard checking account to a new brokerage app and execute a micro deposit of just $50 to $100. Beginners often assume investing requires thousands of dollars on day one. It doesn't. Moving a tiny amount builds familiarity with the app interface and creates the muscle memory of transferring funds without putting your life savings on the line. Step 4 is making the purchase. This is where many beginners misstep by attempting to day trade, pick individual stocks, or speculate on crypto. The most reliable solution for a beginner is to purchase a broad, low-cost index fund. Instead of guessing which single company will succeed, an index fund takes your small deposit and automatically buys a tiny, diversified fraction of hundreds of top companies all at once. This strategy minimizes risk through extreme diversification, which is exactly why legendary investors like Warren Buffett continually recommend low-cost index funds for the vast majority of people. To execute this, open your brokerage app, type a major index fund ticker into the search bar, click Buy, and confirm your $50 market order. It is a profoundly boring process, but the moment that $50 order clears, you have officially crossed the line from a saver to an investor. Step 5 is giving your new strategy the fuel it needs to work. You need to set up automated, recurring monthly contributions so compound growth can take over. This chart compares what happens to $10,000 over a 20-year period. On the left, sitting in a typical 1% savings account, it inches up to roughly $12,200. On the right, earning the stock market's historical average of 10%, that exact same starting money reaches about $67,000. If you simply automate a $300 deposit every month for 25 years, assuming an 8% average return, you end up with roughly $285,000. You only contributed $90,000 of your own cash. The remaining $195,000 is pure compounding. The math works flawlessly on paper, but reality is messier. Eventually, the market will crash, and when it does, the immediate instinct is to cancel those automated deposits. But a drop in the market is not a signal to stop. For a long-term investor, it is actually a distinct mathematical advantage. Look at this sharp drop in share prices. If your automated $300 deposit hits while the market is down, that same fixed amount automatically buys more shares at a discount. When the market eventually recovers, those extra shares drive significantly stronger returns. Maintaining your automated contributions through terrifying headlines and temporary losses is the exact discipline that separates successful investors from gamblers. You now have the complete system in place. You have a cash safety net protected in the bank, a growth account separated at a brokerage, and an automated habit of buying broad index funds every month. Saving money is like storing seeds in a jar. You keep them safe, but nothing happens to them. Investing is planting those seeds in soil. You won't see results immediately, but give it time and it grows into something massive. Saving your cash gives you daily stability, but investing your cash is what ultimately buys you long-term freedom. Are you currently focused on building that safety net, or have you already made your first investment? Let me know in the comments below and hit subscribe for more step-by-step guides.